What's the situation where someone wants to buy a rental property and their bank says no, but they're actually a qualified borrower?
It actually happens all the time. The investor already owns a home. Maybe they already own a rental property. Their personal income is solid, but they've hit the ceiling on conventional financing. Basically, too many financed properties, or the debt-to-income ratio doesn't allow for another loan. There's a product specifically designed for this, and it doesn't care about your personal income at all. The property qualifies itself.
Before we get into the mechanics, who is this loan actually for?
It's a great loan for an investor who's buying a property that generates rental income. It could be single-family rentals, multi-unit properties, condos, vacation rentals. As long as it's an investment property producing rent, a DSCR loan is potentially the right tool. The investor profile I see most often, someone who's maxed out on conventional investment loans. Fannie and Freddie limit you to 10 financed properties. Also, the debt-to-income requirements become harder to manage as you accumulate more and more properties with conventional financing. DSCR removes both those constraints because personal income and personal debt don't enter the equation. I also see it used by self-employed investors whose tax return income doesn't reflect what they actually earn. Same problem as the bank statement borrower, but for an investment property specifically. And I see it used by investors who want to move fast. DSCR loans fund faster than conventional investment properties because the documentation is so much simpler. We're really just underwriting the property, not the borrower's entire financial life.
What's the biggest misconception about DSCR loans?
I think the biggest misconception is that they're risky, or that they're a last resort for borrowers who can't qualify any other way. The DSCR loan is a purpose-built investment product. It's exempt from the ability to repay rules that govern residential mortgages precisely because it's considered a business purpose loan. The property is the business, and the business has to generate enough revenue to service its own debt. That's a sound underwriting principle. It's just different from the consumer mortgage model. The other misconception, that DSCR only works if the property is already rented and producing income. That's not true. For a purchase, we use the appraiser's market rent analysis. You see, the appraiser is required to determine what the property would rent for in the current market, and we use that figure to calculate the DSCR ratio. The property doesn't need a lease in place. What matters is whether the property's income potential supports the payment. And you see, that assessment comes from the appraisal, not from an existing tenant.
Walk us through exactly how a DSCR loan works, the mechanics from start to finish.
Well, first off, DSCR stands for Debt Service Coverage Ratio. And the calculation is straightforward. We take gross rental income divided by the total mortgage payment. And that includes principal and interest, taxes, insurance, and HOA if applicable. That ratio tells us whether the property's income covers its own cost. A DSCR of 1.0 means the rental income exactly covers the mortgage payment. Above 1, the property produces more income than it costs to carry, and below 1, you're supplementing the mortgage out of pocket. For the rental income figure, we use the appraiser's opinion of market rent. On a purchase, the appraiser is required to complete a market rent analysis as part of the appraisal report. You see, they assess what comparable properties are renting for in the same area, and that figure is what we use, which is great because no income history is necessarily required, no existing lease required. If the property already has a lease in place, we can use that as well, but we use the lesser of the actual rent or the appraiser's market rent. Also, there is a cap of 10% above market if the actual rent exceeds market value. And we do see this on some unique properties such as assisted living facilities. And importantly, there's no vacancy factor applied. We give 100% of the qualifying rent figure for the calculation, which is different than conventional loans, which is 75%. For short-term rental properties, there are additional guidelines, including a 20% reduction applied to the market rent figure to account for the nature of the short-term rental income. DSCR absolutely works for vacation rentals and Airbnb properties, but the income calculation is adjusted to reflect that reality. The program allows credit scores down to 620, loans up to 3.5 million, and up to 85% loan to value or 15% down, and multiple finance properties are allowed. There's really no 10 property ceiling.
Give me a real example of how this played out for an investor.
So an investor I worked with had 2 conventional investment properties already financed. They wanted to add a third, a single family home in a strong rental market outside of Denver. Purchase price of $385,000. The property had been rented before and the owner was asking for a conventional loan. The problem, with 2 existing investment mortgages already on his credit profile, the conventional debt-to-income calculation didn't work. The income from the existing rentals was being calculated 75% for qualifying purposes, but his W-2 income alone wasn't enough to offset 3 property payments simultaneously. So he switched to a DSCR loan. The appraiser completed the market rent analysis. Comparable single-family rentals in that specific area were renting at $2,200 a month. The mortgage payment on the DSCR loan with 25% down came into about $1,980 a month. So DSCR is 2,200 divided by 1,980 equals 1.11, above the 1.0 threshold. So the property qualifies itself. His personal income and his existing property mortgages, his debt-to-income ratios, none of that entered into the underwriting equation. The only question was whether that specific property's income covered this specific property's payment, and it did. We funded in 18 days.
What should investors understand going in that most people miss?
Well, there's 3 things worth knowing before you go under contract. The first one is landlord history. The program generally requires that at least one borrower has a 12-month history of owning and managing rental properties. There are exceptions. For example, if the property is under a professional management agreement and certain credit and DSCR thresholds are met, the landlord history requirement can be waived. But this is worth knowing before you apply, especially if you're buying your first rental property. Second is reserves. The DSCR program requires post-closing reserves, typically 4 to 12 months of the mortgage payments held in liquid accounts, depending on the loan amount. So on a $400,000 property, that's a meaningful number. It's real liquidity that has to exist after you fund, not capital you put towards the purchase. And then the third is the rate is higher than a conventional investment loan. DSCR loans carry a pricing premium. The trade-off is access. So you can buy properties you couldn't finance conventionally, you can move faster, and you can scale your portfolio without hitting the conforming ceiling. For most investors doing this strategically, the rate premium is the cost of access, and it's worth it.
What mistake costs investors the most?
What can cost them the most is not understanding the rental market before they make an offer. The DSCR calculation is only as good as the rent figure underneath it. And that figure comes from the appraiser's market rent analysis, which is based on what comparable properties are actually renting for. If an investor's been told by a listing agent that the property can rent for $2,500 a month, but comparable rentals in that area are actually producing $1,900 a month, the appraisal is going to reflect the $1,900. The DSCR calculation is going to reflect the $1,900, and if the loan only qualifies at $2,500, there's going to be a problem. The lesson: understand the rental market for the specific area before you make an offer. Pull active rental listings. Talk to a property manager. Know what the market actually supports, then run the DSCR math with realistic numbers, not optimistic numbers, and before you're under contract. A deal that looks great on a seller's projection, doesn't survive a real market rent analysis, is a deal that falls apart near the finish line. Run the numbers before you're in it.
For an investor who wants to explore this, what are the first steps?
Well, first, before you look at specific properties, get a DSCR pre-qualification. Tell me the market you're looking at, the property type, the approximate price range. I'll tell you what the DSCR threshold looks like, what down payment you need, and what rate environment you're working in. That conversation takes about 20 minutes and it tells you exactly what you're shopping for before you go shopping. Second, when you find a property you're serious about, do your own rental market research before you make an offer. Look at what comparable properties are actively running for in the same area. That's the number the appraiser is going to confirm, and you want to know it first. Third, if you already own investment properties that are conventionally financed and you're hitting a ceiling, call me. There are paths to continue building a portfolio that most investors don't even know exist.
Where do investors find you?
Investors can find me by scheduling a free 15-minute call through teamaronheim.com. If you're looking to add investment properties and you've been told conventional financing won't work for you, this is the right conversation. You pick the time, I'll come prepared with real numbers for your specific situation. You can also text me at 720-200-5464.